IVM.
On this episode of Paisa Vaisa, it's the myth-busting special. We are going to talk about 5 myths pertaining to investments. What is a myth? What is the reality? And how you can correct your investment decisions. My guest to take you through all of these myths is Avinash Luthria, a SEBI-registered investment advisor. This is a really special episode of Paisa Vaisa coming up next.
Hey everybody, welcome to another great week on the IVM Podcast Network. If you aren't following us on social media, please do. We're IVM Podcast on Twitter, Facebook, and Instagram. I'd like to thank our sponsors on the network this week. Thank you HDFC Life for coming on board. We're really excited to work with you. Also would like to thank Storytel for continuing the long time advertising that they've been doing with us. And if you have a brand and you'd like to advertise with us, please send us an email. We'd love to talk to you. Also, folks, please fill out our listener survey. This is the last week it's going to be up. I'm going to take it down at the end of January. Please do try and get your opinion in before then. It is kind of important and it helps us kind of figure out what we should be doing going forward. On Cyrus Says, Cyrus is joined by actor Manvi Gagru, who talks about her upcoming film Shubh Mangal Zyada Saavdhan, working on TVF's popular web series Pictures and how talent show brought her from Delhi to Mumbai. On Advertising is Dead, Varun talks to film critic Sucharita Tyagi, known for the popular Not a Review film series on Film Companion. On Agla Station Adulthood, Ritasha asks Ayushi 36 questions. On Mr. and Mrs. Binge Watch, Janice and Anirudh talk about Season 2 of Netflix's hit show You. On Geek Fruit, Tejas, Jishnu and Dinkar talk about Netflix's Dracula series. On Postcards from Nowhere, Utsav decodes the secrets hidden behind different doors. On IVM Likes, Abbas, Ritika and Antariksha talk about their favorite depictions of heaven, hell and the afterlife in pop culture. On Edges and Sledges, DJ, Ashwin and Varun talk about India bouncing back from a 10-wicket thrashing at Wankhede. On Ganatantra's one-year anniversary episode, hosts Alok and Saryu talk about police reform and why it's so hard. And with that, let's get you back to your show.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter. And boss, this is the myth-busting special. You know, I've done 200 episodes of this podcast. And sometimes I feel, what kind of advice are we giving to people? Is it good? Is it bad? And I think at the margin, I think we are doing a good job. I think, but still, there are still a lot of myths that are going around today about how we should deal with our money. Okay, maybe if you've got friends and family and they tell you a couple of things, do this, do that. Some of it is good advice, some of it is bad advice. But there are some myths, okay, MYTHS, which are totally and completely wrong. And we're going to bust a few of them today. To do that, my guest, Avinash Luthria, is a SEBI-registered investment advisor, okay? And one of the first 10 fee-only, advice-only financial planners in India. He's going to explain to us his background, what does fee-only, advice-only means. And if his name sounds familiar, he's written a couple of very provocative columns on the Ken, okay, which really make you think, because some of the stuff that he's written is contrary to a lot of the advice that you maybe keep on hearing or reading around. Right. So, Avinash, welcome to Paisa Vaisa. Thanks so much for doing this for us. And before we get into the entire myths and realities concept, I want you to tell our listeners something about yourself, because you've got a totally fascinating background. You started your career with private equity and here you are, you're a financial advisor, and I believe among the first in India to have that certification from SEBI. So, welcome to Paisa Vaisa. Let's just start with an introduction to yourself.
Thanks, Anupam, and thanks for having me on the show. A bit about myself. I was an early student of finance from a young age. Realized that I need to get some formal education, so I went to do an MBA at IIM Bangalore. During that MBA, I was also an entrepreneur on the side. So 6 days a week I was a student, and 1 day a week I was an entrepreneur at a startup that I co-founded with a team of lawyers, which did legal research for US law firms, etc. Sometime after that, I joined a private equity fund in its early days. I was in the private equity world for about 12 years. And you're making fairly large investments. You're backing entrepreneurs and you're making fairly large investments of, say, 100 crores each investment. And each investment seems like kind of life or death when you're doing it. But in some ways, I realized that the decisions you make as an individual are even more life or death. A person puts 80% of their money in equity. That's even more life or death than, my 100 crores investment from a 1,000 crore fund in one company. So after about 12 years of private equity, I decided this is what I wanted to do. I had an interest in personal finance for a long time. And Nobel Prize winner William Sharpe has said that, the problem of planning for retirement and investing for it is one of the hardest problems in finance. So I've kind of decided to dedicate the next 20 years to kind of dealing with it, not from the mathematical sense, but dealing with it in the people sense of that problem.
Okay, great. So tell us about the financial advisor part, right? You mean you're a registered investment advisor, which is a SEBI given license, I believe, and which is fundamentally different from what we know as the IFA, the independent financial advisor, or the mutual fund distributor. You offer a paid only service. That is, if I come to you as a client, you're going to tell me, listen, I'm going to, probably look at all your finances, give you a comprehensive plan, and I'm going to charge you for that. Am I right in the services that you offer?
Yes.
How is this different from, the very typical advice that an average guy gets?
Right. So let me just dissect a bit of those terms so far. There's 99% of the market is a commission-based advice, which has conflicts of interest. For example, some financial products or some mutual funds pay fees which are 10 times more than other mutual funds. So naturally, it creates a conflict of interest for advisor.
Because I would then only sell you the one which gives me high commission.
Correct. And that's why you find a lot of people end up getting sold equity mutual funds because they pay higher commission than debt mutual funds. So there's a skew in that direction.
Sure.
The second bit is, so SEBI came up with a classification or a regulation called Registered Investment Advisors, RIAs. And all RIAs are supposed to put the client's interest ahead of their own. So there are a fairly large number of RIAs, and long before I started on this. The difference is there's a bunch of about 13 established people like myself in India today who charge not the normal approach of a percentage of the client's net worth or assets under management. We charge for our time, which effectively in India often means a fixed fee because we're giving a fixed amount of time to each client. We believe that this reduces the conflict of interest even further because, if you're charging someone with 10 crores, you're charging them even 0.5%, 5 lakhs a year. You need to spin a story to justify 5 lakhs of fees a year. You need to give them some really complex advice and make it sound like I'm going to beat the market, all of that. So we think this approach kind of limits the BS and limits the conflict of interest. And there's absurdly only 13 people doing this in India, and established people doing this in India.
Okay,
and I'm one of them.
You've written for Free Fincal. Pattu's been a guest on our show.
Yes. So he runs that list actually, a fairly authoritative list on this. For the last 5 years, he's been running this list. Right. But only 13 people.
Yeah. So guys, I was referring to Pattu, who runs freefincal.com, the blog, and he's been a guest on our show. We had like 3 massive episodes on financial freedom, and my God, that got a really good response for us. And Avinash is listed on Pattu's site, and he's written for Pattu also, and he's written for a whole lot of other publications, from Business Standard to ET to Mint and even the Ken. Okay, and talking about the Ken, you've written some pretty provocative articles out there on how the industry is probably geared to sell higher commission products. I want to just use that as a starting point to get into our show. Right, so folks, we're going to talk about a few, I don't know, maybe 3, 4, 5 or how many other myths that Avinash has got for us on this show surrounding your investment habits. Okay, now we'll go into a break after we've done probably 1, 2 or 3 myths, and then we'll continue on the other side of the break on the same line. Then we'll wrap up with, maybe some habits or some tips that Avinash can give. So let's get into this, Avinash. Okay, let's start off on a few myths, reality, and what listeners should do to correct the behavior. Okay, let's start.
Sure. The first point is saving, and you get a whole range of advice on saving. You get everything from one end, people saying save 50 rupees a day is enough, and you have other end people saying, okay, 20-30% of your post-tax salary, you just save that and it's enough for your goals, including retirement. That's not true.
Okay.
Let me rewind a bit to tell you why it's not true. But let me just first start with a very simple example, given the way I think of it, and I'll explain that subsequently. So let's say you're saving 25,000 rupees from your salary every month. You as a couple are saving 25,000 rupees every month. The way the maths really works, it means that during your retirement, you will have 25,000 rupees in today's purchasing power, 2020 purchasing power to survive. That's it. And that's not going to buy you very much. Sure. If you're going to pay rent from it and you're going to pay whatever, you're really not going to be left with very much to survive. So you're going to be living a pretty bad retirement. The way the math works is something like this, that you have some of the mistakes in that calculation is people use very high equity return assumptions. They assume very high allocations to equity, and they assume that most of your portfolio is in equity. But the reality is that equity is only one part of your portfolio. Returns are unlikely to be that great. Particularly post-tax and post-inflation when you look at it. And as you get older, you'll probably move your portfolio more and more towards safe assets. So when you look at the whole blend of it, what taxes eat up, what inflation eats up, your investments are just running in pace to keep up with inflation pretty much. Maybe marginally more if you're lucky. So I've written about this on FreeFinCal, where I've said that you should just assume that you'll get 0% real returns. What that means in simple English is your investments on the whole portfolio just runs in place to keep up with inflation. Sounds very conservative or pessimistic, but it's not actually. And once you do that math, assuming that your investments just keep up with inflation, you're actually going to be living off just your savings.
Right.
Your savings are just, that purchasing power is what you're going to be living off. So when you slice and dice the numbers, you finally find that if you want a decent quality retirement,
Sure.
you need to be saving about half of your post-tax salary, which is
Wow.
pretty painful and pretty
is,
tough.
Yeah, it is.
It's tough for all of us.
Yeah.
So
50%
yes,
of post-tax.
Post-tax salary.
So if my salary is 100 and I'm paying probably say $20 for tax, okay, assuming there are probably people higher than that or maybe lower than that. So you're saying I'm left with 80.
Yeah.
I should be saving 40.
Yes.
Wow.
Painful.
That is painful, but that's a fact. If you want
Yes.
a reasonably good life after retirement.
Yeah, I think a lot of advisors feel that you don't want to scare people by telling them something that's almost seems impossible. My view is it's better to know the truth
Reality.
earlier rather than later, and it may be too late at some point to fix it.
Great. So can I take that as a first myth?
Yes.
And that's the first tip for our listeners?
Yes.
Guys, get used to saving much more than what you are right now. Of course, if you're already saving 50%, then good for you, I guess.
Yeah, actually, so just some of my clients, because they're in IT jobs who have, they don't have visibility of their jobs beyond say 40, 45. Then maths works out to they need to be saving even more than 50, but let me not scare the listeners further.
Great, yeah. Thanks for the good tips. So on a regular recurring basis, if you've got visibility of your job, then it's good to just save that slightly high amount. It just makes your life easier after you retire. Number 2, chalo, let's do this.
Sure. The next myth is people say that equity is safe. If you're going to be saving for a 5 or 10 year horizon, then equity is relatively safe. Let me rewind and say what they're actually saying. So they're saying that, yes, we all realize that equity is very volatile, very risky. But that's in the short term. If you look at it over 5 or 10 years, pretty much equity the levels out, and you'll do better. You'll do better than any safe investment. That's pretty much what you hear. So let me just lay out how scary it is in the short term firstly before we talk about the long term.
Okay.
So if you rewind to 2008-9, the Nifty 50 index, including dividends, was called Nifty Total Return Index, fell by 59%.
Wow.
And that was a large cap index.
Yep.
The mid cap index fell by 73%, and the small cap index fell by 76%. So just think of it, if you had 1 crore, in the large cap you're down to 41 lakhs, in the others you're down to some 25 odd lakhs. It's pretty devastating.
Yep.
But everybody says, no, don't worry. I mean, just like 2008-9, it bounced back in 18 months.
Yep.
Don't worry. Over the long term, it's all fine. So this is something that finance professors have debunked repeatedly. Practitioners keep saying it, but finance professors have debunked it repeatedly. The truth is, as we speak in India, starting from 8th of January 2008, the peak of the market then, cumulative inflation has been about 7%. We went through one small phase of high inflation.
Yes.
Right now it's a little lower.
Yes.
But cumulatively it's been about 7%. And since that peak, the stock market, the Nifty 50 index, including dividends, has done about 6.7%. So it's just about catching up with inflation, really, 12 years later, 2008 to now, which is a pretty long time. So the point being that if it's taken 12 years for it to catch up with inflation, there's really no guarantees that equity will beat inflation. When people say equity is safe, they don't really define what they mean by it. The way to define it is, will equity beat inflation over 5 or 10 years? There is no guarantee on it. And we're actually sitting through a 12-year phase where it hasn't. And there have been phases in history in the US where we have longer data, and other countries where there have been periods of 15, 20, 30, 40, 50 years where equity is not beaten inflation.
Right. So that just shows that if you're assuming that equities are safe over a 5 or 10 year horizon, well, data says that you're wrong.
Yes, and that people use that argument to then justify young people having 80% in equity, etc. Forget about just the fact that we're not robots who can, not panic in a 2008-9 type crash. It's just not true. So it's better that people know the reality, and when you do the math, it's kind of hard to justify more than a 60-70% allocation to equity, even for a young person.
Right.
It's debatable, but it's kind of hard to justify more than that.
Okay, so what would be a good guideline, a good rule for the listeners? If someone tells them that equity is safe for 5 to 10 years, ideally, what should be their behavior towards this to correct this myth? What do you think would be the right way?
I would say just use a rule of thumb. Don't go beyond 60-70% equity allocation. There may be a lot of arguments for the very high equity allocation, but just say that, think of it like a coin toss with equity. It's like a coin you're going to toss. There's a 2/3 chance it'll beat inflation over any period of time, 5, 10, 20 years. And a 1/3 chance it won't beat inflation. This is the coin toss they're facing. So you accept that it's a coin toss and over whatever period of time, and just accept that I can't put all my money in that coin toss. Let me have some of it which is outside of this coin toss.
Outside of equity and probably into debt or any other asset,
Yes.
where you know that you have a higher chance of a lower return than a higher chance of a volatile return.
Yeah.
Okay, folks, we're going to take a small break on that. Just to recap this first part of the episode, in the first myth that Avinash told us about was the percentage of savings that you have to do. A lot of people probably go with 20, 25, 30%. Well, if you want to have a slightly more comfortable retirement, you should be looking at 50% of post-tax salary. Okay, so just keep that number in your mind. And the second myth that we spoke about was equity returns. Someone's told you that equity is safe over 5, 10 years. Well, guess what? History doesn't support that argument because, as Avinash said, over the last 10 years, inflation has been about 7%, and the Nifty total return index for the last 10 years has given 7%. So it's just kind of catching up on that. On the other side of this break, we're going to be back. We're going to talk about a few more myths, the realities, and how to correct them. Don't go anywhere. We would like to thank HDFC Life Insurance for supporting this show. HDFC Life Insurance has created an online video series called Behind the Journey with some of the most interesting people from the creative and entertainment industry. It explores the stories that are behind the glitz and glamour of the spotlight and screaming fans. Let's listen to a snippet from the episode featuring comedian Zakir Khan.
It's not like कि मैंने आज यहाँ पे ये पैसे इन्वेस्ट करें तो इसमें तो इतना रिटर्न आया नहीं, अब मुझे नहीं करना. एज आर्टिस्ट होना जो है वो लॉन्ग टर्म गेम है, वो शॉर्ट टर्म गेम नहीं है. आपको उसको कंसिस्टेंटली अप्रोच करना पड़ेगा डे बाय डे एंड फॉर इयर्स.
Long-term consistency is essential as it helps an artist grow, and consistent effort helps growth in your finances. You can watch all episodes of Behind the Journey on the HDFC Life Insurance YouTube channel, youtube.com/HDFC Life. Take control of your personal goals with HDFC Life Insurance's financial solutions. Plan now with HDFC Life Insurance.
Terms and conditions apply. HDFC Life Insurance Company Limited, IRDAI, registration number 101.
And welcome back to this special episode, the myth-busting special with Avinash Luthria, a SEBI-registered investment advisor. In the first part, we spoke about how much you need to save, what people tell you and what the reality is. And we spoke about equity returns, what people tell you and what the reality is. Avinash, let's do some more myths, okay? Let's start off with the next myth, the reality, and how we can change our behavior so that we don't fall for the myth.
So the next myth is about commissions on all financial products, but let's be specific about, say, mutual funds. And the myth really is that if you pay 1% of commissions a year, it really doesn't matter because your returns are so much higher, 13, 14, 15%. You're getting advice for it. So 1% doesn't really matter in the scheme of 14, 15%.
And just to clarify, commission means when you're paying an agent or a distributor or an IFA for buying a mutual fund or investing through him, right?
Right. So people firstly don't realize that they're paying a commission. It gets deducted from the net asset value of your mutual fund. So you don't really pay it.
A regular plan.
Yes, regular plan of mutual fund. And the common myth for many people is they think there's probably a one-time commission that the person's getting. Actually, it's something like 1% getting deducted every year from your money. That's how. But the myth really is that 1% doesn't really matter. It's 1%.
Big deal.
Yeah.
Yeah. I mean, if I'm doing 100 rupees, 1 rupee goes to the guy. He's probably doing something for me. So let him do.
Yeah.
What's the reality?
The reality is that the 1%, we see it on a per year basis. Especially if you look at this concept of zero real returns, it kind of focuses your mind that, your money is not growing at all really on a blended basis. If you lose 1% the first year, you're down to 100 is down to 99. You lose another 1% the second year, you're down to 98. You lose another 1%, you're down to 97. You do this over the next 30 years, you've lost 30% of your money. Every year it seems very little, but when you do it over 30 years, you've lost 30% of your money. So, you live your retirement with 30% less money. It's a huge amount of money when you look at it over those little drops of water adding up over 20, 30 years.
Like saying that if you develop a corpus of, if I'm doing a direct plan and you're doing a regular plan, you're saying that I'm going to reach 1 crore you'd probably be at 70 lakhs.
Yes, in terms of purchasing power, yes.
Would
correct.
that be a right comparison?
Yes.
So how do we correct this behavior?
So SEBI luckily has offered direct plans, which are plans without commissions, to all of us. So you don't need any kind of advisor. You can go and buy them yourself. We'll talk about some of the products later, and they're so simple you don't really need an advisor at all for just buying these products. It's a pretty terrific innovation of SEBI, that saying that you don't have to go to anyone. It's your money, you keep it. You want to spend it, give it to someone for advice, give it. And SEBI's actually allowed that. So every single mutual fund in India has a direct plan, which allows you to save on this commission of, say, 1% or a little less than that every year. And you need to look for the word direct plan. If it doesn't say anything, if it says regular plan, it's a regular plan, it means a commission plan. The words are very confusing. Regular plan is actually commission plan. And if it doesn't say anything, it's also still a commission plan. So you need to look for that word direct plan. The only exception is ETFs, exchange traded funds, are automatically direct plan. So, but otherwise, for most normal people, look for the word direct plan.
Yeah, so that's like saying that if I see a mutual fund which says XYZ mutual fund, super duper fantastic regular scheme, say, okay, that is a regular scheme, means I'm paying commission. And if the same scheme, okay, without the word regular, but with the word direct, means that's what I should go for.
And if it doesn't say anything, it's actually a commission scheme.
Okay, folks, look out for that. Okay, regular versus direct. What's next?
What you'll hear everywhere is that the average mutual fund, the average active mutual fund really, and let's say equity for the timing, the average equity mutual fund beats the index. And that's why you go to a fund manager, because he can make you richer by beating the index.
Yeah.
So that's what we all hear in the papers, and we've been hearing that forever. And that's what you still hear even today. As you'd expect, the reality is different.
Okay.
And now you're getting to hear a bit of, in the press saying, okay, in large caps, it's getting harder for the mutual fund managers to beat the index. And it's recently a problem where the mutual fund managers are finding it difficult to beat the large cap index. But don't worry, we'll come to that. But there's mid caps where they can beat the index. And maybe there are a few fund managers. You've got to find the right fund managers.
Correct, yeah.
Who will beat the index.
Yeah.
Maybe. So a lot of that. So let's take each of these through.
Sure.
Firstly, Standard & Poor's puts out a report every 6 months all over the world, and they do one in India. They've been doing this for about 10 years now. And the report for the last 10 years has been saying that the average equity mutual fund manager, at least in large caps and pretty much everywhere, doesn't beat the index. Strangely, that's not what you hear in the news. So that's point number one. The second is the statement that, okay, yeah, but the mid caps fund managers can beat the index.
Correct,
or mid cap, small cap. There, the report, which is called the S&P Indices versus Active Funds India report, SPIVA, is a little more ambiguous. But ambiguity doesn't mean proof that the managers are able to beat the index. It's basically there's enough noise in the data. There aren't enough funds to look at the data. And the reason why this analysis in general is so different from what you'll find as you could say other amateur analysis is that the worst performing mutual funds get merged into the better performing mutual funds, and they disappear from a database that you go to check Value Research or Morningstar. You won't find their data.
Sure.
So you as an individual or anyone doing analysis looks at the surviving mutual funds, which are by and large have done better. And that's something called survivorship bias. And this report is the only one that corrects for it. So when it corrects for it, it finds that the data is ambiguous on mid caps and small caps. Don't know. But large caps, it's pretty clear the average fund is matching the index. It's not, after fees, is matching the index. It's not beating the index, but that's where it is.
Okay.
The last bit people will counter it with saying that why don't you go find better managers, mutual fund managers, and they will beat the index. The tough part, Standard & Poor's did this research too, and they looked at, if you look at the last 5 years data, that's not enough to help you figure out who's going to beat the market, which manager is going to beat the market in the next 5 years. So data can't tell you, so what's going to tell you the answer? You'll have to do some magic to figure that out.
Throw a dart
no
or
one
something.
can do that magic, really.
It's just a coin toss, as you said.
Actually, that makes your life easy, paradoxically. All that you need to do, if you subscribe to this view and you read the report, and I've written some articles explaining this report table by table. Once you subscribe to this view, actually, you might feel defeated that, I can't beat the market, I'm going to have to save more. But you could also just accept that and just say it makes your life very simple in terms of fund selection. And I was saying you don't need an advisor. That's the reason. You just buy the Nifty 50 index fund, end of story.
Okay.
That's all that you need. And most of them are similar. You just look at the lowest fees. If they charge you 0.1%, great. That's the one you want to buy.
Sure.
And that's the end of story.
Fantastic. So stick to ETFs or index funds.
Yes, stick to the Nifty 50 index fund. Don't go with any other index funds. These are the cheapest ones because this is the dominant product that even the EPFO, the Employee Provident Fund Organization, invests in.
Puts their money in that. So that's as safe as it can get.
At least that's the cheapest product that you can get.
Sorry,
yes.
not safe, but cheapest product.
It's simple, cheap. You don't need an advisor to do it.
And what you see is what you get.
Yes.
Nifty goes up, you can see it every day. Nifty goes up, you can see it every day. Okay, Avinash, so we've got time for maybe one or two more. So tell us, what do you have for us?
Sure. We spoke about equity just now. Let's look at one on the debt side. So on the debt side, debt mutual fund side, the standard view is that you need to find debt mutual funds which give you good returns. And how can you get good returns on debt mutual funds? Which category do you need to pick? Do you need to pick credit risk funds? Do you need to pick gilt funds? I mean, do you need to pick
ultra short, liquid, PSU and banking?
Yeah, exactly. Corporate bond fund. There's an infinite number of them, really. The myth here is that actually, okay, firstly, let's start. Who needs a debt mutual fund? Firstly, what is a debt mutual fund? A debt mutual fund is when you get to the nitty-gritty of it, it's actually just a way to get a more tax-efficient product for someone in a high tax bracket. So if your tax bracket is below 20%, you don't really need a debt mutual fund. If you're 20%, you may or may not be benefited by a debt mutual fund compared to a fixed deposit. If you're at 30 or more higher tax bracket on your income, then a debt mutual fund might help you. If you can stay invested for about 3+ years, it'll help you maybe make about 0.5, 0.6% more than a fixed deposit. A little bit, but that little bit is worth it because as you know, it adds up every year.
Yep.
So that's firstly, a debt mutual fund is just a more tax efficient mechanism to keep your money safe. That's how you should be looking at it. So there's actually a finance theorem called the separation theorem, which says, just keep your safe money safe and keep your risky money risky. Don't mix them up. So going by that theorem, all you need to do is you've already figured out the equity bit, which is a Nifty 50 index fund. You just need something as safe as a fixed deposit. And the category that does that is two things. One is pretty much a strange category called overnight funds. And you have a whole bunch of them. The money that you give them, they'll lend it in the overnight lending market.
Okay.
This category is used by institutions, etc. So the fees are very low on this. Again, 0.1% fees on this, on almost all of these products.
Sure.
So you can just buy any of them in the direct plan, fees of 0.1% per annum. There are few liquid funds by a few others which offer this zero risk approach. So a few of them are, the first such product was Quantum Mutual Fund. The second was from Parag Parekh Mutual Fund, PPFAS, and the third is from Motilal.
Okay.
So actually you can go look at the portfolios. You see they only hold government treasury bills.
Okay.
It's easy for people to understand the portfolio. People find it a little more difficult to understand overnight fund and what it's doing.
Sure.
But essentially they're both pretty much the same. You'll probably just about beat the fixed deposit by 0.5% post-tax. But that's what you should be happy with. If you're unhappy with it, decide can you put more in equity or not, and you'll find pretty much that you can't. So don't, just live with it.
Okay, Avinash, so we've come to the end of the show in terms of the myth. Okay, you can think of this as a rapid fire thing or whatever, but we're not Coffee with Karan. Look at this in this way. I'm going to tell you the myth. Okay, we're just going to recap the entire show in a short form for our listeners. I'm going to tell you the myth and you're going to tell me the correct behavior. Okay, here we go. Myth number 1. Savings just need to be 20-30%. What's the right way to correct this?
Save 50% of your post-tax salary.
Myth number 2. Equity returns are actually pretty safe over a 5-10 year period. What's the reality?
They're not. So don't put more than 60-70% of your net worth in equity.
Myth number 3. Hey, a regular fund, just 1% more. How does it matter? What's the reality?
Only invest in direct plans or mutual funds. Look for the word direct plan.
And the difference it makes is
30% of your net worth at stake.
Myth number 4. The average active mutual fund actually beats the index. Whereas the reality is?
It doesn't. So it actually simplifies your life. Just buy the Nifty 50 index fund. End of story.
And finally, hey, I'm going to buy a debt fund. I should look for the highest possible return on my debt fund. What's the reality?
Debt funds are just to save your money or protect your money. Invest in overnight funds. End of story.
Fantastic. So folks, that was the myths. That's the reality. Then that's what you should do in terms of corrective behavior. I'm sure all of you are wondering where you can reach out to Avinash for probably a more detailed discussion on each of these things. Okay, we've just summarized some very generalized myths and some very generalized solutions. As Avinash would admit, that each case of a person is very different. So Avinash, tell us something about yourself in terms of the work that you do. Do you have a blog? Do you have a Twitter account? Where can people read more of your thoughts on these topics? And most importantly, how can people reach out to you?
Sure. So I write in Business Standard, Mint, Money Control, a few other places, FreeFinCal on Patu's site, as you mentioned. And I've covered a lot of these topics in those articles, and you can find more details about many of these. Actually, so my website's fiduciaries.in. It's a bit of a mouthful. It's FIDUCIARIES.in. But you could say that, I may not be the right person for some people in your audience, but Patu's list has a list of over 13 people on the FreeFinCal website. And I'm pretty sure that if people went and did their research, they'll find somebody who fits their style and what they're looking for. And there are good people out there and they should work with them.
Sure. And just tell me one thing. Maybe I'm asking a biased question out here, but do you think that good advice is worth paying for?
I actually have, my clients are a fairly mature set of clients and fairly knowledgeable. So actually that's what I specialize in. So I have clients who are fund managers, etc., who do see benefit in such advice. So I think the fact that fund managers are finding this advice worth paying for is probably some proof of the pudding.
You've got fund managers client. Awesome, folks. So that is a wrap on this show. On the myth-busting special, my guest, Avinash Luthria, SEBI registered investment advisor who runs or who's part of this wonderful initiative called Fiduciaries. Fiduciary is actually, what's the meaning of...
So the term is in the SEBI regulations of an RIA, which a fiduciary is someone who's supposed to put the client's interest ahead of their own.
Right.
So I just stole the word from the regulation and using it on the website.
We did 5 myths, 5 realities and 5 behaviors that can correct your investment making decisions. Avinash, thank you so much for joining us on this show. I'm sure, our listeners know where to reach out to you if they have any questions. Thanks so much for doing this. And folks, that is a wrap on this show. If you think you have any feedback or if you do have any feedback, reach out to me. I am B50 on Twitter. Send us a comment. Leave us a comment on the IVM website. Give us a rating. Give us some feedback. We love that. Avinash, thank you so much for joining us.
Thanks, Anupam.
No material on this show should be considered as financial advice. The material on this show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Are you looking for India's most awesome cricket podcast? Are you now tired of listening to the same old guys drone on about cricket everywhere? Edges and Sledges is a weekly cricket podcast hosted by 3 fans of the game, Varun, DJ, and myself, Ashwin. It was established in early 2018, has over 60 episodes now, and is of course now proud to be on the IVM Podcast Network. Each week, we get together from 3 different time zones, the USA, the UK, and Singapore, and we talk about things from the world of cricket, with a focus on Indian cricket. We often interview special guests from all around the world, including former cricketers and cricket media personalities. So check out Edges and Sledges, the cricket podcast, now on the IVM Network.